Oil falls as markets weigh the end of US summer demand. Brent hovers near the high 60s. Here's what that actually means. Seasonal demand is fading as the US driving season winds down, and spot prices are reflecting that softer gasoline pull. Brent is trading around $67 to $68 a barrel and WTI near $64, which is modestly lower week on week. The smarter read is the mix of forces underneath: demand expectations, OPEC plus supply signaling, and your local currency versus the dollar. When demand cools and the dollar strengthens, crude prices tend to ease. When supply risks flare or currencies weaken, the pump pain returns. Oil is the input that moves everything: cars, trucks, planes, and the goods they carry. Gasoline affects commuters and casual drivers. Diesel hits delivery fleets, farmers, and construction. So diesel swings often filter through to grocery shelves and shipping fees. The pass-through isn't instant and it isn't equal. Taxes and exchange rates act like shock absorbers, so the same oil move can feel mild in one country and sharp in another. Watch the curve and the headlines. If supply remains comfortable and demand cools into autumn, pressure on pump prices and airfares typically softens. If OPEC plus tightens, geopolitics disrupt flows, or the dollar drops, oil can push higher again and reheat transport costs. Bottom line, today's dip isn't just trader noise. It's an early indicator for your commute, your deliveries, and your basket. Track your local pump price, make small adjustments to trips and orders, and let the seasonal easing work for you until the next supply or currency shock resets the story. Follow for more finance news and how it really impacts your wallet.